Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, everyone, and thank you for tuning in to another episode of No More, Risk Better. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy at CreditSights, and today I'm delighted to be joined by my colleague Matt Woodruff, who is our head of aerospace and defense and transports at CreditSights, and we're going to be talking primarily airlines, starting with the news of the day, news of the month, Spirit Airlines. But before we dig into that, Matt, thanks so much for coming back on the podcast.
Hey, thanks, Zach. Thanks for having me.
All right. So as I alluded to, for everyone that hasn't been living under a rock, probably knows that Spirit Airlines went bankrupt a week or two back. Maybe it was just last week. But Matt, can you just give us the details, start by framing up maybe the size of Spirit in terms of the major U.S. airlines, the low-cost carriers, the ultra-low-cost carriers, and kind of take us through the recent events and what you think it means for the market here in the U.S.
For sure. Absolutely. So certainly a big event here. Spirit actually went through two bankruptcies, believe it or not. So the first one was in November 2024, and that was a very short bankruptcy, and unfortunately didn't do much to improve the cost structure of the company. So during that bankruptcy, they took out a little bit of debt. They kind of changed some things with their revenue model, but really didn't change the company too much. And unfortunately, that led to a second bankruptcy, which occurred just 170 days after emerging from the first bankruptcy. So the second bankruptcy started in August of 2025. And actually, so just last week, the court approved a liquidation of the airline, and they stopped operations on May 2nd. And so Spirit had shrunk, they're in the process of shrinking already. And so far this year, in 2026, they had a seat market share of about 1.7% in the United States. And that was down, pretty significantly. In 2023 was their peak. In 2023, they hit 5% of seats. But really overall, given the size, they were pretty insignificant, kind of on a global basis. They were the 7th largest U.S. airline by passengers flown last year. And, it's definitely an interesting case. But, I would attribute their failure to really, a few things. But most of all, they had a bit of a revenue problem post-COVID. And that was because I would blame it on the slow return of business travel in the United States. Because business travel kind of lagged the COVID recovery, you had mainline airlines like United and Delta and American that were offering up a basic economy product, which was essentially, quite similar to the product that Spirit had. So Spirit had this kind of a la carte, ultra low cost carrier model where they charged very little for the seats and then a lot for the upgrades. And the mainlines were offering the same product essentially at just a slightly higher price point than where Spirit had. But in addition to that, the mainlines had the front of the cabin where they were charging a whole heck of a lot of money. And they also had the loyalty programs where they're making a ton of money as well. So that was quite difficult from Spirit's perspective because it just capped where they could increase their fares to. And all airlines really had a significantly higher cost of operating post-COVID. And because Spirit really had that cap on where their fares could go, they just had a much harder time. There's also kind of some company-specific things. About 25% at one point of their fleet was grounded due to some engine issues that they had with Pratt & Whitney, and they got some compensation for that, but it was clearly disruptive to kind of overall costs. And then they also just got really big. So at their height, they got to the size of 214 aircraft, which is pretty decent size. That's about 20% of the size of the mainline fleets of the major carriers. And at that many aircraft, you have to compete directly with those mainline airlines. And because they had to compete directly with them, and they did have the cost problems and didn't have the revenue problems, ultimately it just led them to fail.
That's interesting and helpful framing the size. The thought comes to mind is part of this, I think there's clearly a lot that went into this, but is part of it outside of the business travel that you highlighted, some of this K-shaped economy that we're experiencing now, where you're really seeing the front of the plane driving growth or revenue, whatever your favorite way to express it, for the major airlines, and you just don't have enough demand to go around for either the back of the plane on the big guys or just clearly a Spirit. And I guess secondary to that, I'd be curious how the low cost carriers, so not ultra low cost like a JetBlue and a Southwest, fit into the picture.
Yeah. So, I mean, definitely the K-shaped economy plays a big part here. And for the upper end of the K, for kind of the legacy airlines, the mainline airlines, United, Delta, and American, it takes, a couple different forms. And probably the most important form that they have is the loyalty program. And so, loyalty program has a few different revenue streams, but the most important revenue streams comes from credit cards. And the credit card business, think of it in this way: they're essentially buying miles or points from the airline for 2 cents, basically, that are maybe worth maybe 1.3 cent. So for the airline itself, is extremely profitable. So when customers go to redeem it, it's only worth 1.3 cents. But they've actually sold those points in advance for two. So it's hugely profitable and huge deal. Delta, I think, is up to about $8 billion of cash that changes hand in a year from their partner, American Express. And the other guys are right there and hopefully catching up soon. So it's hugely important, and it's a lot of credit card spend, and the more you're spending on that credit card, the more it benefits the airlines. And so definitely probably the most important part. But then also, yeah, the front of the plane is super important. Where whether you're talking about retirees that can afford to buy some of these pricey seats in the front of the plane, and probably virtually anyone that is looking at some long haul flights has noticed that business and first class travel has only gone up. So airlines have really realized that there is a lot of demand out there at the high end, whether it be from the wealth effect, from the stock market just being very, very resilient and recovering very, very nicely in the COVID period, or just a large number of retirees in the post-COVID period as well that are looking to kind of take advantage of that. The other thing is, I mentioned business travel was slow to come back, post-COVID, and business travel has certainly come back, and that's certainly on the upper end of the K as well. I would argue, though, for most people that are flying on just about any airline, you're going to be in that upper part of the K. It is, rather, pricey to do a
Yeah.
trip and an all-in basis. So most people are on that upper end, but certainly, the higher end of a customer that you can cater to, the more successful you're going to be in this environment. No question about it. And so you asked about Southwest, and so Southwest business model is different for sure. And so they're considered a low cost carrier as opposed to an ultra low cost carrier. And Southwest also, has struggled until very recently. And a lot of the struggles at Southwest had to do with the fact that their business model hadn't really changed in a way that some of the majors had. And so the majors kind of adopted to the ultra low cost airline way of doing things, which is charging for each incremental thing, charging to assign your seat, charging for a better seat up front. charging for bags. Southwest hadn't done any of that. And so they really struggled until this first quarter. Actually, they posted a really, really solid first quarter for the first time, realizing a lot of the revenue from charging for bags, from seat assignments. So it seems to be, going better for them. And knock on wood, that will continue. You have solid investment grade credit. It's been that way for very, very long time. We think it's going pretty well, for them at this point. But with the fuel situation, there's a lot going on, and everyone has a lot to deal with.
So before we go to the rising fuel costs, which is certainly front and center for the airlines, I want to ask, of course, there's been plenty in the headlines about JetBlue considering buying or merging with Spirit. I don't recall when that was. Was that 2024, maybe before the first bankruptcy, or coming out of the first bankruptcy? Either way, yeah, take us through that and maybe your perception of, was that an error, or was Spirit kind of doomed and combining them would not be a helpful solution to the market? And lastly, absent this Iran war, could Spirit have kind of made a go of it for much longer from your perspective?
Yeah, so it's an interesting question. Yeah, for sure. So so my view is, I would say JetBlue's view was that they needed to gain scale in order to effectively compete with American, and Delta and United. They felt like they were subscale, and the only way that they were going to be able to compete with the legacy airlines was to gain size. And their idea was to kind of merge with them. And I think the idea first surfaced in the 2022 period, and then it kind of went into 2023, where it was shut down on antitrust grounds by the previous administration. And I think they were probably right, in a lot of ways. In order to have an effective offering, they did need to increase their size. But that being said, JetBlue has really, really struggled for similar but slightly different reasons. JetBlue's network is on the East Coast, of course. There are big market shares in New York, big market share in Boston, and also Fort Lauderdale. And the problem with all those places is they're high cost areas to operate. It's very expensive to land, a passenger at LaGuardia Airport, for example, one of the most expensive places to land in the world. And when you have an ultra low cost carrier model or a low cost carrier model, and you're trying to keep your fares down, certainly below the legacy airlines, it's quite difficult, in those markets. And they have struggled to do so. The profitability has been quite low. They also don't have the premium offerings, and importantly, they don't have as large of a loyalty program as the majors do. Although they do have a decent sized one, and it is growing nicely. But it's just a very, very difficult place to make money, in that area. So, in my view, if they would have merged with Spirit, it would have. I don't know if it would have saved, a combined Spirit JetBlue from a bankruptcy situation. JetBlue is still in a very difficult situation here, and we kind of view it as maybe they have a path to possibly get through this current cycle, but it looks pretty tough for them, and leverage is certainly very high. They're burning a lot of cash. Adding, 200 aircraft from Spirit at a relatively low cost point that would also have been losing money, probably wouldn't have helped that. What would have been perhaps more helpful is bringing in an airline that really doesn't exist today, an airline that has longer haul only flying that could help JetBlue, kind of reach further into Europe, for example, maybe even further into South America. Some of the Latin American routes that they do right now could extend some of those. That would be super helpful for a company like JetBlue. That company does not exist, though. We don't have an airline in the United States that just does long haul. So there's really, kind of no ideal partner for them that I think would have saved them from their current issues. There's been a lot of talk lately about a potential combination with United, and seemingly that would be a decent combination. United has expressed interest in their position in New York. And
JetBlue and
so,
United, that is?
Jet, JetBlue and United, yes.
Okay.
And so
All right. So
they have,
that's what United was really going for when they floated the American merger? Is that the
yeah.
takeaway?
So the CEO of United, Scott Kirby, has kind of let it leak that they were entertaining a potential merger with American, and of course, a couple of weeks ago, he put out a press release, kind of saying, "Hey, we thought this was a pretty good idea, but American really didn't want to engage with us, and they're not entertaining that idea." And so, I think that was served a couple of different purposes. One, I think it was to put it out there that yes, in fact, he was entertaining a real merger with American, which would just create an absolute behemoth. We'd have lots and lots of market share issues, on a local basis. I think something like it's 11 or 12 local markets would have a combined market share with the American and United above 40%, which seemingly would be a lot of issues that they would need to deal with, a lot of divestitures. But from Scott Kirby's point of view, he thinks that a combined airline would be able to better compete, particularly from an international point of view. And so United's strategy for competing has really been to create an airline that is focused on international, and they've done a pretty good job with it. But I think that he feels like they've reached the point that they need to get even more scale to compete with some of the airlines that are subsidized by some countries, and in the Middle East, or some of the larger airlines in Europe and Asia as well. So that's kind of his view of the world. But he put that commentary out there. Nothing really came out of it. American said, "Thank you, no, thank you. We're not entertaining anything of the sort." And the world has kind of moved on from here. And so, yeah, there's definitely some speculation that maybe the next look would be JetBlue. Although, he has said actually publicly that JetBlue is a little small, and if he was to entertain a merger, he would really prefer to do something larger. So I think that's him really kind of still holding on to American. There's some other reasons why, American's involved. Scott used to work at American, so he's extremely familiar with the fleet and everything that they're doing there. Obviously, as a competitor as well, he's super familiar with the airline. So I think he'd rather do American, but, maybe JetBlue comes closer into focus moving forward.
JetBlue wouldn't help with the big long haul competition or international competition. So that would be a kind of a completely different strategic justification, I guess.
Yeah, so they wouldn't help with the long haul, but they do have a pretty big position at JFK. And if United were to take that position in JFK, they could certainly do a lot of long haul flying from there. And a lot of United existing partners today, fly into JFK. And so the connectivity that would be allowed from United taking over JetBlue's current position at JFK would be extremely powerful. So you get the initial kind of price fare increase from just being branded United, but then on top of that, the connectivity with all the partners at JFK would be, I think, quite profitable. So there is reason to believe that they could do a lot with that JetBlue position in JFK, and of course, United's kind of undersized in South Florida, so Fort Lauderdale could potentially be interesting. Although with Spirit exiting Fort Lauderdale, there's some question as to how much United will get anyway there. And then on the Boston side, United's undersized there as well. So presumably that would be interesting as well. So JetBlue doesn't have the aircraft necessarily for the long haul, but they definitely have, the airport and gate positions that could be used for that long haul flying.
That's interesting and helpful context that makes sense now that you lay it out, but certainly didn't immediately occur to me. So shifting gears a little bit, rising fuel costs, we've sort of touched on this. I've got a chart in our typical deck right now looking at a variety of U.S. energy prices. You have New York jet fuel up, I think, about 50% since the start of the war. How much did that play a role in, I guess I should say, Spirit's ceasing of operations on May 2nd. And for the record, we're recording this on May 12th. And how concerned are you about the impact on the broader airline industry from higher jet fuel costs? And maybe just to set the stage, I know our colleagues at BMI have come out with an updated projection for the path of the Iran war, thinking that it could last another 6 weeks in their base case. So how do rising fuel costs fit in with your kind of assessment of the industry overall, and how much of a role did it play in Spirit's ceasing of operations?
Yeah, so fuel costs is definitely a huge topic right now, and really everything that all the airlines on a global basis are dealing with. I tend to look at fuel costs on a year-over-year basis because the business is so seasonal around travel in the summer and then travel around holidays as well. When you look at it on a year-over-year basis, fuel is up about 100% right now. So hugely expensive. And the math that kind of everyone goes through is fuel is about 20% of revenue. And so if that 20% of revenue cost is up 100%, that means we need to increase prices by about 20% or fares by about 20% to get back to break even. So you hear a lot about, well, we need to increase prices 15 to 20%. United uses those numbers a lot. And that's where that kind of comes from. I mean, this is a huge shock to the system. There's no doubt about it. And I look a lot at forward curves, and forward curve expectations are super important. And for the second quarter, the quarter we're in right now, second quarter of 2026, the pricing on the forward curves has been relatively consistent and have actually come down somewhat from their peak. But when you look at the consecutive quarters, the third quarter of this year, the fourth quarter of this year, and then through 2027, the forward prices have increased over time as the Iran, U.S. Situation has not been resolved. And so commodity traders actually came up with a new name. I think the first time I saw it was last week. It was the nacho trade, which is not a chance Hormuz opens, which I guess is an addition to the taco trade. So now we've got multiple Mexican dishes involved in trading. This is the first time I've seen that. I thought it was pretty entertaining. But certainly, when we look at the commodity side, this not a chance that Hormuz opens has been in effect for most of the commodity trading. You haven't really seen it too much in the bond and equity side until like the last couple of days. And so we're recording May 12th here. And the last couple of trading days, you have seen some of the bonds react to this, possibility that fuel is going to be higher for longer. So a lot going on here is going to affect all the airlines. For Spirit, did not really affect them. Spirit lost about $100 million in February alone on $200 million of revenue. So they were really in the hole. That was before fuel prices went up. And it was really the business model issues that we went through, and kind of their inability to pass through the higher costs that just kind of killed them. And then, the fuel thing was just kind of a guarantee, more or less. It made the chances of them being a going concern to zero. So, might have had a very minor impact on what happened there, but we think not a huge part of the Spirit failure, but maybe guaranteed it, as opposed to having maybe a 1% chance of getting out of their situation or something like that. So not a huge chance anyway. The government did entertain possibly bailing them out, so that was kind of interesting. But ultimately, it was decided that in order to do that, there was really no way to do it without harming current creditors. And of course, current creditors were not on board with that at all. So without current creditors on board, that did not happen. And we're now fully winding down the airline. So it's definitely a concern for all airlines. We've published a bunch of different sensitivity analysis around prices and where do prices need to be. But one of the things that we're thinking about is, economics 101, when prices go up, typically quantity demand falls, right? And so during first quarter earnings, pretty much every airline said, hey, demand is so great. Like, this is the best time, whether you're talking international or you're talking domestic. We have so much pricing power out there, and we can just increase prices and it'll be fine. And so interestingly, what we've seen recently is, so prices definitely have gone up, but over the last month or so, post Easter, we've seen a decline year over year in the number of actually travelers reported by TSA. And so it's in a current basis, it's down about 2 to 3% year over year. And so things aren't maybe quite as rosy as what the airlines were kind of indicating to us just 4 weeks ago. So it's definitely something that we're watching. As far as airlines that are kind of critically affected by this, we've already talked about JetBlue. So JetBlue has $9 billion of debt. They've raised about $500 million in a aircraft-backed facility already this year. That's expandable by $250 million. Based on our projections on the current fuel curve, we think they're going to need a little bit more money to get through the year. We do think they have the possibility of, or we do think they have the ability to raise that money, though. They have enough assets available to them to use as collateral that they could use. They could get that extra $500 million. So we think JetBlue is going to survive, through the end of this year. However, if we get into next year, fuel prices are still high. It could be increasingly difficult for JetBlue to affect that turnaround. So we have a whole view overall on JetBlue from a credit perspective. So things are the loyalty bonds are right around 89 cents on the dollar sitting here today. We've published a recovery analysis. We think there's a ton of asset value at JetBlue. And one of the nice things about JetBlue as it exists today and was a bit different than the Spirit structure is they have, they own a lot of their aircraft, and there's a lot of value within that aircraft. Despite the current environment right now, aircraft values seem to be holding up. So pretty high value on their aircraft leads to some residual value that would go all the way down to the unsecured creditors, we think. And so we do think the recovery will be decent in that one. And so we have a whole view on that, but recognizing that they're going to be under pressure as fuel prices are high. Other kind of companies that are airlines that are kind of under pressure is Alaska. So the West Coast is going to be the most affected by this. West Coast fuel prices are the highest of anywhere in the country. Alaska also has a unique situation where they actually source a decent amount of their fuel from Singapore, and Singapore is pretty bad right now from a pricing perspective. Availability of fuel in Asia is extremely challenged at the moment. So that fuel that they're getting, from that region is also pretty darn high. They just did a deal. They needed some liquidity. They did a $500 million bond deal and a $500 million loan last week. We think that'll get them through 2026, but leverage is climbing to like 9 times, we think there. And we think that they're going to need a little bit more money next year as well. We have an underperformed view on Alaska as well. That deal came at about 6.5%. We wanted closer to 7 on that one to like it. So I could go through some of the other airlines as well, but the bottom line is everyone's going to be impacted by this. We are going to see, virtually every airline looking to tap some excess liquidity. The only airline really with a very good liquidity position at this point is United. So United has about $14 billion of cash, which is hugely important. It's funny, we were joking as the year started that all of the other airlines had kind of been paying down their debt and retiring some of that excess liquidity. Excess debt and with excess liquidity that had been really gotten post-COVID. And United was one that didn't do that. They're kind of holding on to a lot of that post-COVID excess liquidity. So they're in a very, very good position. They're trying to get to investment grade. We do think they're going to get there. Maybe this kind of current fuel environment extends that a bit, but we think they're super well positioned to get to investment grade. So we're holding on to it, outperform on United.
So the one airline that comes to mind, particularly with respect to the fuel cost challenges, is Delta. And I didn't know this until I was reading one of your notes on the sensitivity analysis. They own their own refinery. So I'd be curious from your perspective, how important is that right now with the current dynamics that we have and fuel price increases that we've already seen? And maybe more importantly, how important is it in kind of eliminating tail risk for Delta should this go on for a lot longer? Are they already seeing benefits of having their own refinery and being the only airline that has that? Or is it more of a mitigation of a worst case scenario? Take us through some of the dynamics there.
Yeah, so the refinery so the main reason why they bought the refinery, I think it was back in is 2012. They bought this refinery, and I think they bought it from Phillips 66. This was a refinery that was set to be shut down, and Delta viewed that as particularly problematic. They have a nice position there on the East Coast. Obviously, they're a premium airline, but they do a lot of flying on the East Coast, and they were primarily actually worried about the availability of fuel. And if this refinery was shut down for a long-term period, where there'd be enough fuel available. So some of the same concerns that we're worried about in Europe and Asia right now in terms of not even having the fuel, that's what Delta was thinking about in the long run. And so that was the primary reason why they bought it. It is helpful, from an expense perspective. Basically, the way I think about it is they kind of save on what's called the crack spread, or the cost that between crude oil and the refined fuel. They could save on that because they're making it themselves. But the benefit is really kind of marginal. So it's about, they laid out the benefit for them in the second quarter as being $300 million, and that's a $300 million savings on what's going to end up being a $4.5 billion fuel bill for them. So it's really a modest benefit. It's better than nothing, though. I mean, so
Better than
maybe
nothing.
the benefit's only 7%. It's better than others have, though. At this point, really nobody else has that, any kind of hedging on of any size. So it's definitely better than the other folks do. I think all the airlines have kind of took this view in recent years, I'd say over the last decade or so, with Southwest being the most recent to kind of change their view. Southwest had hedges on for a very long time until recently. But most airlines had kind of taken the view that, hey, here in the United States, we went from relying on the Middle East, for all our oil and oil-related products, to the United States really being the center of the world, or so the thinking goes, in terms of oil supply. And so since the fracking kind of revolution, worst comes to worst, if we have $100 oil, a bunch more supply will come on hand, become available, particularly here in the United States, and we'll be okay, was kind of the thinking. The other thing that they looked at was they kind of looked at the costs of hedging over a long period of time, and most of them had lost money on their hedges over a long period of time. So they all made the decision to kind of take that off, and kind of paying the price today. I do not get the sense that any of them are looking to restart any kind of a hedging program because of what we're going through right now. I think there is an expectation among these airlines that oil producers will step up. If we end up in a $100 plus oil situation for an extended period of time, I think they do expect additional production to come out of the United States, and which should help with oil prices. So I think we do have this kind of one-time dealing of with the price increases that are necessary. And hopefully the net effect of that on quantity is such that we can kind of hold on to some level of profitability after this year. But from a fuel hedging perspective, I don't expect really any changes from the group.
That's really interesting and maybe somewhat unsurprising, but to think about saving on the crack spread, which I think is certainly historically wide in this environment, but at the end of the day, the big thing is the jump in oil prices, and having the refinery just doesn't really do anything on that end. So I think having those numbers, 300 million in savings on 4.5 billion in costs really helps frame that up. Certainly having the 300 million still in your pocket versus the other airlines is helpful, but maybe not a game changer. And so I think that's certainly interesting context.
At least, we're not hearing about concerns about fuel shortages here in the United States. And I think Delta would point to that as being the main reason why they bought it. They didn't buy the refinery for very much, and they weren't expecting a huge amount of savings, but at least the availability is there. So the fuel is there, even if it's expensive.
Right. Kind of eliminates some form of tail risk, which is more front and top of mind perhaps in this environment. But now that we're, a net energy exporter in the US, less of a big deal than it would have been 10 or 15 years ago when they made the decision.
For sure.
All right. We hit a lot, Matt. This was a really great and interesting discussion. Is there anything we didn't cover that is top of mind in your space? Any other M&A potential or anything like that you want to highlight before I let you get back to it?
Yeah. So just tomorrow, actually, we're going to get a merger in the industry. It's going to be a pretty small merger. So we have Sun Country and Allegiant They are combined, they'll have about a 2.5% market share. So not super huge, but this idea that a new era of combinations may be upon us is certainly starting with that combination tomorrow. And the other thing, I just reinforced the fact that the previous administration really did not have a favorable view of consolidation. And given what we went through with Spirit and the Spirit JetBlue merger being shut down, and also the Northeast, alliance between JetBlue and American Airlines getting shut down, it does kind of seem like, it's a ripe opportunity for combination. So certainly something that we're going to keep an eye on. From our seat, Alaska and American seem like, an obvious combination. They already do a lot of code sharing. American does a lot of flying for Alaska across the continental U.S. Alaska has kind of the West Coast covered, and then, of course, also into Hawaii and Alaska itself. American seems to be a perfect combination for them. And then we've already talked about United JetBlue. That's the other kind of combination that seemingly makes sense as far as potential combinations that are out there. So it'll be fun.
Yeah, a lot to keep an eye on. I think I flew Allegiant maybe 14 years ago from the beautiful Concord, North Carolina airport down to somewhere in Florida. Great experience.
Very nice.
and very inexpensive. So that's interesting to see them combining with Sun Country. Is that right? I've never taken that one.
Yeah, so Sun Country had kind of the second position within Minneapolis. Sun Country does a lot of cargo flying, but they also kind of do very, very seasonal service, and that's what they share with Allegiant. Both Allegiant and Sun Country have no qualms in not flying during periods of low demand. So for Tuesdays, for example, or Wednesdays, they might completely shut down some of their aircraft within their network. So it's they take a more extreme approach to their aircraft usage. When demand is low, they literally don't fly their planes. So they're somewhat similar in that respect. But Sun Country has a very nice number 2 position in Minneapolis. The number 1 position there is Delta, which of course is fairly high fares. So it's enabled Sun Country to carve themselves out a nice little business there as the number 2. So fairly similar businesses, kind of combining there, and we'll see what's next.
Awesome. Well, I think that's a great place to wrap up. So thank you, Matt, for coming back on No More Risk Better.
Sure thing. Happy to be here.
And thank you all for tuning in. We'll catch you next time.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.